In this video, I'm going to be breaking down exactly how the market moves. I think a lot of people, especially traders, I don't actually think they have proper knowledge in regards to how the market actually moves. So I'm going to be dissecting that in this video and going a little bit deeper. But before we get into that, I just want to knuckle down on one simple concept. And that is that the market is a big auction, okay? We have buyers and we have sellers, and the market facilitates trades between buyers and sellers. So that means in order for you to buy a stock or a futures contract, there needs to be a seller willing to sell the stock at that certain price or a futures contract at that certain price level. So we are all familiar with supply and demand. So when supply relevant to demand is higher, we get prices moving down. However, when demand relevant to supply is more, then we have prices moving higher. So in a market, we have two different types of participants. We have the aggressors, who are market buyers and sellers, and then we have passive buyers and sellers, also known as limit orders. As we said, the market is a big auction, so we have an order book that shows us all the limit orders that are placed in the order book. However, footprint data, on the other hand, shows us the actual market orders. The difference between these is a market order is an executed order, and that can be shown on a level 2 or a footprint, whereas a limit order is something that's waiting in a queue to be filled and can be pulled at any point. So that means it's very difficult for us to use limit orders in an order book for our trades. Now I'm going to dive deeper into the order book to show you how these limit orders are placed. So let's move on. So this is what an order book looks like. We have buyers on the left hand side. We have sellers on the right hand side. This is the price in the middle. So for example, this is a stock of Apple. Current price right now of Apple is $100. That's the current price of this stock. So we have 10 orders sitting at $100. We have 10 contracts or 10 shares, whatever you want to call it, that are willing to sell at $100. They're willing to sell their shares at $100. And then we have 10 orders sitting here willing to buy this stock at $99. Okay, so these are all limit orders. The order book only displays information on limit orders. So the point of this is, as you can see, we have sellers willing to sell at 100. So we have 10 contracts or 10 shares, and we have 10 contracts or 10 shares of buyers willing to buy at 99. So right now we don't have an agreement between the buyers and the sellers. So we have buyers who are saying, okay, we want to buy at 99. We have sellers saying, no, we're going to only sell at 100. So if we just had limit orders in the book like this, the market would just not move because there's no agreement between the buyers and the sellers. Okay, this is why we need market orders. Okay, this is market orders that are moving the price. So what market orders do is there'll be participants like you or bigger players in the market who are just saying, okay, this is the price. The price is $100. I am willing to buy this stock at 100 right now. Okay, so let me give you an example. You come in and you say, okay, you know what? I'm not waiting for an order to be placed in the book. I want to get in right now. Or a bigger players come in and said, okay, I'm not waiting. We are going to get into this stock. We want to buy it right now. So you, for example, you place an order of 15 shares to buy this stock. Okay. Now we know that we have 10 shares waiting at $100. So you have now, this goes to 0, okay, and this now goes to 30. So part of your order, part of your market order, 10 contracts or 10 shares have been filled at 100, and the remaining 5 have been filled at 101. Okay, and that's the same on the downside. Okay, if you are selling and you place 15 orders, you would get filled, 10 orders would get filled at 99, and the remaining 5 orders would get filled at 98. That's why when you place an order on your exchange, you'll get an average price, because not all your orders will get filled at one price, especially if you're market buying in or selling. So you won't get filled at the exact price because it depends on how many orders are stacked. Okay, these sometimes are referred to as sell walls, and these are referred to as buy walls. Okay, so the point of all this is we need market participants to be able to start knocking through these orders. Okay, and a lot of people, this is sometimes the order book is called a DOM. A lot of software refers to this as the DOM, and you can have this as part of your trading. You can use it as part of your trading, but the purpose of this video is to explain the order book. Okay, I fully understand how the order book works, even though I don't incorporate it into my trading, and I'm going to explain a little bit about why. I don't think that an order book is as useful as some traders think it is. Okay, it's a great tool. Okay, it can give you an idea of how strong either the sell side is, okay, or the buy side. Okay, so some novice traders, or I don't even call them novice traders, some beginners would come in and they would look at this and say, okay, we have 1,100 contracts at this price. That means there's a huge sell wall here. Okay, so that means there's going to be obvious resistance at this point, and it's going to take a real big push from the buyers to get through 1,100 contracts. Okay, so you can see prior to that 35.10, you know, the book is quite thin on the buy side, but we have this huge order stacked at 1,100. Okay, so a lot of people would look at that and say, okay, that's a pretty safe place to put an order in because it's obvious resistance. So you come in and other participants in the market also will come in and say, all right, I'm gonna put some orders in at 102 because we're gonna definitely get some resistance at this point. All right, so other people also look at this level and say, right, this is obvious resistance, we're gonna put some orders in there. So now we have an additional 1,000 orders placed at 102. Okay, so now what happens is this number goes from 1,100 to 2,100 contracts. Okay, now it's huge, right? So more people are looking at this. More and more people looking at this and thinking, wow, that's a huge order. There's going to be some obvious resistance here. And maybe there's going to be more orders placed at 102. But for the purpose of the example, stay with me. I know this can get a little bit confusing. But, okay, now we have 2,100 orders placed at 102. The price starts moving through these orders. So market buyers are coming in and moving this price. Now the price is starting to move a little bit higher. Okay, people have started placing limit orders at 102. The price is now 101. Now what happens? All of a sudden, the person or the bigger player in the market who placed these original 1,100 orders, he takes these orders out of the book. He takes them out completely. Okay, In other words, this is also known as spoofing. So what he does, he takes 1,100 orders out of the book, and that now has gone back to, that has gone back to 1,000. So that's gone back to 1,000 orders. So what he does is he comes in to buy the market because he wants a big order to be filled. So he goes and buys 1,200 contracts, okay, at 101. So he takes out this, he takes out all your orders, he takes out these 1,000 orders, and now he starts pushing the price higher, starts getting more and more aggressive. Why? Because he needed liquidity to be able to fill those orders. So he spoofed people into thinking that, okay, look, we have a big sell wall here, but as soon as the price starts reaching that level, he's pulled his orders and reversed it, because his intention was never to fill those orders at 1,100. His intention was to drive this price higher, and he needed to spoof you into thinking there's a big sell wall there, so you go and place your orders at that price. So this is the reason why, or one of the reasons why, I don't like looking at DOM or using an order book. Okay, it's a fantastic tool, but the point is to understand the mechanics behind it, and how a market moves is the most important thing. And if you want to use it, that by all means, there's nothing wrong with using it. Okay, it can be very reliable as well. I personally just do not use it, because the information that you can get off the order book, you can get off the footprint as well. Okay, because footprint is actual executed orders. With the footprint, those are market orders. They can't be manipulated. That's what's gone through the market. They're executed. There's no way to reverse those orders. Whereas limit orders, what I try to explain is limit orders, they can be pulled at any point. Okay, so even these orders sitting here at the buy side can be pulled at any point. If somebody thinks, you know what, okay, it's not looking good, I don't want to fill my order, he can just pull his order and get out the market. No damage. Okay, whereas market orders, those are executed orders, and when you can see from market orders and footprint data where there is absorption. Okay, so for example, I'm going to just give you one example. If there's aggressive market buyers hitting the bid, but the price is just not moving, that is clear indication that there's a big player sat in the market absorbing all these market orders. Okay, so that's one of the reasons for me I don't need a DOM. Okay, because I can see it from the footprint, and I can see it from the CVD with divergences and things like that. But that's for another video. I'll make a video on footprint, explain those concepts for a later video. Another way of looking at this is, if a bigger player in the market wants his order to be filled, for example, he comes in, he wants a big order of 1,000 shares to be filled. He wants to get in at 100. However, there's only 10 orders waiting in the book for him to be able to fill. So he wants to fill an order of 1,000, but there's only 10 in the book. So what's going to happen? He's going to start filtering through all the orders that are sitting higher. So there'll be orders sitting at 105, 106, 107, 108. So his big order of 1,000 will make the price of this Apple stock that we're saying hypothetical, this price will jump to around 110 or 112, whatever, depending on how many orders were sitting in the book waiting for this big block of 1,000. This is why you see sometimes in the market the price, it just makes a sudden jump. That's because there's a big order, the big market order placed in the market, and there's just not enough liquidity from the limit order side to be able to handle those orders. So it just it just flicks through all these levels because just not enough liquidity. That's what we call thin books. The books are thin. Somebody comes in, places a big order, and it just ramps up the price. The problem with this is, from a big order perspective, is that their average price is not going to be 100. So their intention was to fill majority of their orders, the 1,000 orders, at $100, but they're not going to get that fill because this is just going to keep going up and up and up until those 1,000 orders are filled. And by the end of it, those 1,000 shares that they weren't filling, the average price could be around 112, 114, 116, okay, depending on how thin the books were. Obviously, they have information. They have this information. Bigger institutions, bigger players in the market, they have this information and they will place their orders accordingly so that they avoid this. They don't, it doesn't happen. So this is why they use the concept of spoofing, and why I think order book is not as useful as looking at raw data like the footprint. So just to recap, what we have to understand as traders is the market moves with supply and demand. And our job is to be able to identify those levels of supply and demand and then determine who is in control at those levels. And a part of that is understanding the order book or the DOM, because market orders and limit orders, they go in hand as we have just explained. And I know a lot of this is a little bit foreign to a lot of retail traders because we are so used to trading candlesticks and retail chart patterns like head and shoulders or channels and things like that. So this can take a little bit of time to understand. So the way I use this information and the way I trade is I use areas of high volume or areas of high supply or high demand. I identify those areas and then I use the stuff that I showed you in regards to footprint market orders. Who is the aggressors when we start to reach those levels? So we get into an area of supply. Are we getting buyers stepping in to try and drive the price out of that supply zone into another supply zone? So it just depends on what type of imbalances we are seeing, whether we have limit orders sitting at those supply zones, soaking up all these market orders, or whether the buyers are able to drive those prices to different higher levels. So to conclude everything, what you have to realize is the market is one big auction. It facilitates people to buy and sell stocks or futures contracts on a daily basis, and our job as traders is to use that information. It's now readily available for us to use, and that can greatly help us facilitate our trades and be on the right side of the market. Okay, so if you want to learn more, if you want in-depth information and in-depth strategies that we use to help us facilitate these trades, then come and be a part of the group. We would love to have you come and be part of the courses that people are taking to help them understand the theory. And if you don't want to do any of that, then at least give us a thumbs up, hit the subscribe button, and we shall see you in the next video. Thank you for watching. Peace.